Welcome back to the Deep Dive. It is Thursday, February 5th, 2026. And I have to say, if you're holding Estee Lauder stock today, you have my genuine sympathy.
Yeah.
Because we are not just looking at an earnings report, we're looking at a crime scene.
It really is carnage out there. I mean,
And
you just don't see a blue chip company like this get taken out to the woodshed.
we are focusing entirely on Estee Lauder companies, ticker symbol EL. And usually we ease into these things, but we have to address the sheer violence of this move. The stock closed down 19.20%.
Almost 20% in one day. For a company of this size, that's a capitulation event.
It dropped from about $119 all the way down to $96.66. I mean, that's roughly $23 of shareholder value per share, just poof, gone in 6.5 hours.
And it wasn't a slow bleed either. This was a gap down right at the open. Investors just wanted out. And what makes this so fascinating to unpack is the paradox here. If you were just skimming the headlines, you might have thought they had a pretty decent quarter.
That is the part I really want to get into first, because on paper, they beat estimates, they grew revenue, and yet investors just pulled the ripcord. So our mission today, it's not a victory lap, it's an investigation. We need to figure out why a beat resulted in a bloodbath.
It really comes down to this huge disconnect between the story management is trying to sell and the patience the market has left. There is like a canyon between the adjusted numbers, the clean story, and the really messy reality of the GAAP numbers, plus some very specific, very annoying headwinds that investors are just tired of hearing about.
All right, so let's look at the evidence. Give us the top line snapshot. Was demand actually there?
Surprisingly, yeah, revenue was solid. They brought in $4.229 billion, which was up 6% year over year. The street was looking for $4.22 billion, so they came in just a little ahead. People are still buying the products.
Okay, so the revenue engine is running. Now, what about the bottom line? Because this is where the accounting gets a little acrobatic.
Acrobatic is a very polite way to put it. So if you look at the adjusted EPS, that's the non-GAAP number where they strip out all the one-time costs, they reported $0.89.
Okay.
That beat the consensus of $0.84. And it was up a staggering 43% from last year.
A 43% jump in earnings per share. I mean, that usually sends a stock soaring.
Usually.
Yeah.
But then you look at the GAAP EPS, the actual reported earnings, the number that actually hits the books, that came in at $0.44. The consensus was looking for 78 cents. So on a GAAP basis, they missed by 34 cents. It was a massive miss.
Wow, that's a huge spread. So adjusted, they're heroes. GAAP, they are struggling. Clearly, the market decided today that it cares about the GAAP number. But why now? I mean, companies use adjusted earnings all the time.
They do, but there's a limit. I mean, the gap here is mostly these restructuring charges. We're talking about $94 million, mostly employee-related costs to, fire people, move teams around, plus some tax impacts. The problem is Estee Lauder has been restructuring for a long, long time.
And that brings us to our first major theme, this Beauty Reimagined turnaround versus the actual reality. It feels like they've been reimagining this business for, 3 years now?
Yeah. Management, led by the CEO, Stéphane de La Faverie, is selling this whole narrative. They have the Profit Recovery and Growth Plan, the PRGP, they have the One ERC operating model. It's a lot of acronyms that basically just mean we're trying to fix things and cut costs.
But the market is saying, stop telling us about the renovation, just show us the finished house.
That's it, exactly. When you keep adjusting out the costs of fixing the business, eventually investors start to wonder if those costs are just the permanent cost of doing business. You can't claim one-time expenses every single quarter. The market's exhausted. They wanted clean profit and they got a messy spreadsheet.
It's like a friend who says they're between jobs for 5 years. At some point, that's just their status. Okay, but let's move to the second theme, because this was the part that really surprised me, the geography split.
This is critical. I mean, if you look at the global luxury market right now, LVMH, Kering, all the big names, everyone is screaming about a slowdown in China.
Right. The narrative is that the Chinese consumer is just tapped out, they're saving money, not buying luxury. So I would have assumed Estee Lauder got totally crushed in China.
And that assumption would be completely wrong. They actually outperformed in mainland China. They posted double-digit growth. Double-digit. Gained market share in all 4 categories: skincare, makeup, fragrance, and hair care.
That is a huge anomaly. How are they doing that when companies selling handbags are seeing sales drop off a cliff?
It's the lipstick effect in action, just updated for 2026. So when consumers feel uncertain, they stop buying the $3,000 handbag, but they don't stop treating themselves. They go for the affordable luxury.
Right.
$100 bottle of serum or a Tom Ford lipstick, it feels like an indulgence, but it doesn't break the bank like a big purchase does.
So they're capturing that trade-down behavior?
Precisely. And they're executing really well on the ground. The CEO specifically said that even though consumer sentiment in China is, subdued, their localized marketing is winning. They are defying gravity over there.
So China, against all odds, is the hero of the quarter, which must mean the drag is coming from somewhere else. Is it Europe?
Nope. The anchor dragging this whole ship is right here at home, the Americas. Their most profitable region is just struggling. Sales are expected to be flat for the full year.
Flat sales in the U.S. But the U.S. economy is supposedly doing fine. Why can't they sell makeup in America?
It is a channel problem.
Yeah.
I mean, think about where Estee Lauder grew up. They were the queens of the department store. Macy's, Saks, Nordstrom.
Right, the glass counters with the people in the white lab coat.
Exactly. Well, nobody goes there anymore, or at least not enough people do. Department stores are now less than 30% of their mix, but the decline is so severe, it's just canceling out the growth they have elsewhere.
Right.
So they're frantically trying to pivot to these high-growth channels.
I saw they mention Amazon.
They did. They have 12 brands live on Amazon Premium Beauty now. And this is a huge cultural shift for them. MA is finally going into Sephora US.
Wait, MAC wasn't in Sephora in the U.S. before. That just feels like a massive oversight.
MSC was in Ulta and department stores and their own shops. But yeah, entering Sephora US is a huge milestone. It shows they're finally admitting they have to be where the young traffic is. But the problem is, while they build up Amazon and Sephora, their old department store business is just melting like an ice cube. It's a race against their own history.
So a messy transition in the U.S., a surprising win in China. But that brings us to theme 3, and I think this is the specific detail that really spooked the market, the transitory headwind. What happened at the airports?
Okay, so this is a fascinating logistical nightmare. Travel retail duty-free shopping is a massive business for them. Historically, it's been one of their highest margin channels. You have a captive audience, buying big bundles of product tax-free.
I've seen the lines in those stores. It's serious business.
It is. Well, specifically in travel retail east, so think Beijing and Shanghai airports, the operators of those duty-free shops are changing. It used to be a company called Sunrise. Now the contracts are moving to players like China Duty Free, Wang Fujing, and Avolta.
Okay, so the landlord is just changing the tenant. Why does that crash the stock 19%?
Because in the middle of this transition, the digital plumbing got severed. There's this universal app. Think of it as the central way to pre-order duty-free goods in that region. That's a huge sales driver. People order on the app, they pick it up at the gate. That app was shut down during Q2.
Shut down.
Completely. And this is the kicker. It remains down.
So the store is basically closed.
The digital store is closed. And because they don't have a firm date for when it turns back on, it creates this massive revenue hole for Q3. It pushes all that expected revenue into Q4.
Ah, the dreaded back-end loaded year.
Investors hate back-end loaded years. It's basically management saying, trust us, the last 3 months are going to be amazing to make up for the mess right now. It just raises the execution risk so much. If anything at all goes wrong in Q4, they miss the entire year.
It removes any margin for error. And speaking of margins, we have to talk about the guidance. Because despite all this, they actually raised their full-year earnings guidance.
They did, yeah. They raised the adjusted EPS guidance to a range of $2.05 to $2.25. It was $1.92.10 before.
That seems confident. Maybe too confident.
It signals they believe the cost savings are real. But, and there's always a but, with them, they also said Q3 operating margin is going to contract by about 50 basis points.
Why? If the full year is better, why is the next quarter worse?
2 things. One is timing of investments. They're spending a lot on marketing now to drive those Amazon and Sephora sales later. But the second one is the big macro buzzword that every investor is terrified of right now, tariffs.
I had a feeling we weren't going to get through this without talking about tariffs.
No way. Management put a number on it. They expect about $100 million profitability headwind, mostly hitting the second half of the year, purely from tariffs.
$100 million is not a rounding error. That's real money.
It's a huge chunk of profit. And they said it's already hurting consumer confidence in places like Latin America. So when you combine a $100 million tariff hit with a shutdown app in Shanghai and flat sales in America, suddenly that raised guidance feels incredibly fragile. It feels like they're walking a tightrope in a hurricane.
Okay, let's zoom out for some investor context. Before today, the stock had been on a tear. It was up, 46% over the last year from the lows in April 2025?
And that's the setup for the crash. The expectations bar was just incredibly high. The market had priced in a perfect, hockey stick recovery. They thought the bad news was over.
And instead, they got a checkmark recovery down first, then maybe up later.
Right. Investors are rejecting the volatility. They see the turnaround is happening in the P&L. I mean, margins are expanding. Gross margin was up to 76.5%. But the exposure to these binary risks, like is the app on or what's trade policy going to be, it makes the stock toxic for certain funds.
Is there any good news on the product side of things? Or is it all just supply chains and taxes?
No, the product engine is actually working, and this is the glimmer of hope. They talked about innovation velocity.
That sounds like a corporate buzzword, but break it down for me.
It really matters in beauty because trends move so fast on TikTok. If you're slow, you die. They're now launching 19% of their innovation in under a year. That's a huge speed increase. And they highlighted the success of the Estee Lauder Double Wear Concealer and the continued monster that is Le Lobo.
Ah, Le Labo. I feel like I can't walk through a coffee shop anywhere without smelling Santal 33.
It is the scent of a generation. And that brand just keeps growing double digits. It proves Estee Lauder still knows how to build these massive brands. The problem isn't the product. It's the plumbing that gets the product to the customer.
So we have a messy quarter, a punished stock, but a premier asset with undeniable brand power. This brings us to the part of the show where we start looking at the past and look at the opportunity. It is time for our This Is Not Financial Advice segment.
And as always, we're not financial advisors. This is purely for entertainment and education. If you follow this idea and lose money, please do not send us the bill.
But if you make money, feel free to send us a bottle of Le Labo. Okay, here's the pitch. I call this trade the lipstick arbitrage, or maybe the airport contrarian.
I like it. Walk me through the setup.
Okay, so the stock is down nearly 20% in a day. Panic is at its absolute peak. Implied volatility, which is just the measure of how much the market expects the price to swing, is sky high around the 80th percentile.
High implied vols means options premiums are really expensive. It's like buying flood insurance while the water's already rising. You're going to pay a premium for it.
Correct. So in this scenario, we want to be the insurance seller, not the buyer. The trade is to sell deep out of the money puts, let's say at the $85 or $90 strike price, expiring in a few months.
So you're basically telling the market, I promise to buy Estee Lauder stock at $85 a share if it falls that far. And for taking on that risk, the market pays you cash right now.
Exactly. You capture that massive volatility premium because everyone else is panic buying protection. But here's the logic. You are fundamentally betting that Estee Lauder is not going to zero.
Which is a pretty rational bet. This is an 80-year-old company with very strong cash flow.
Right. And look at the headwinds we just talked about. The airport situation. It's logistical. The shops are not gone. They're just changing landlords. The app will turn back on. And demand in China, their most critical growth engine, is actually growing double digits.
That is the key differentiator. If China demand was collapsing, I'd say don't touch this thing. But if the problem is just that the digital door to the store is temporarily stuck, well, that gets fixed. It's a solvable problem.
So you sell the puts. If the stock stabilizes or bounces or just doesn't drop another 15%, you just keep that juicy premium. That's income generated.
And if it does keep dropping, what if the knife keeps falling?
If you get assigned at $85, you end up owning one of the world's premier beauty companies at a multi-year discount, a price we haven't seen since the depths of the crisis. Right as their Beauty Reimagined cost savings are supposed to be fully kicking in for fiscal 27.
So you're either getting paid to wait or you are buying a blue chip stock at a fire sale price.
It is the classic value investor move. You use the market's emotional overreaction to your advantage. The lipstick isn't broken, just the shipping crate.
It's bold. I mean, it requires a stomach for volatility because this stock is going to swing. But the logic, it holds up. You're betting on the brand's durability over the supply chain's fragility.
So to wrap this all up, Estee Lauder delivered a good beat, bad vibe quarter.
The operational turnaround is actually happening. Margins are up, costs are down, cash flow is doubling. But all of that good work is just obscured by messy GAAP numbers, tariff fears, and some really, really unfortunate timing at the Beijing airport.
Management called fiscal 26 a pivotal year.
And it looks like the market just decided to wait until the pivot is actually finished before buying back in.
Well, we will certainly be watching. Keep watching the tickers.
See you next time.